Hi, everyone. Thank you for coming to our first presentation for Financial Literacy Month. Today's presentation is the real cost of shopping. My name's Dahlia Jones, but everyone here in the office calls me Dee. And today I'm going to be presenting with peer mentor Devin Cooley. You want to wave and say hi?
Hi,
Um,
cool. Thanks for
we will
coming.
be yeah. So we will be talking about how in-store credit cards, POS loans, and more can possibly impact your credit. So stay tuned to learn more about that. Alrighty. So we're going to have our first poll right now. So the poll is, have you ever used one of the following? In-store credit card, POS loan, payday lender. So go ahead and check it off and let us know if you've used one of those before. Okay. So it looks like everyone has voted. So it looks like about two of you guys have used in-store credit cards and one of you has used a POS loan. Okay, Klarna or Afterpay. I personally have not used any of these at all a day in my life. So it's very something new that I've heard about. But there was a time where I was a senior in high school and I wanted to buy a computer. Uh, and so I decided that I was going to go ahead and try to get an in-store credit card at Office Max. Needless to say, that didn't go well because I had no credit. So I tried applying for the credit card and they were like, yeah, you don't qualify. So that was the first and last time I applied for an in-store credit card. Um, and now that we're on the topic, I'm going to go ahead and pass the reins over to Devin.
Thank you very much, Dee. So we are talking about consumer debt right now, and consumer debt is almost synonymous with credit cards, and that's actually for good reason. So the average US credit card debt per US family is at around $6,270. So it's a pretty hefty amount. And if you look at the graph to the right, us potential graduates will likely experience a higher amount, most likely due to higher incomes typically and lifestyle inflation, which tends to happen if you don't keep it in check. In addition to the average debt per family, the total credit card debt in America has reached $807 billion. You can see all the zeros right there. So this number is actually the highest it's been over the last couple of years. So it's been on the rise. Uh, but this number pales in comparison to the total amount of debts that we in the US have per consumer debt is $1.4 trillion. So even more zeros than the $807 billion number. And our credit card debt only makes up about 5.6% of that total debt if you do the math. So this number actually means, since it's been lower over some years, that our credit card debt is rising while all the other debts are rising at a higher rate. So we're taking out more and more debts while our credit card debt is actually rising. So it's pretty crazy stuff right there. This is why we figured it'd be a good idea to go over some of the ways consumers borrow money to buy things. We are taking out more and more in general. We might as well know a thing or two about what we're doing. So let's start off with in-store credit cards. Thank you. Imagine you walk into your favorite clothing store. For me, that would be H&M. I like to shop there. It's pretty cheap. It has some nice stuff. So I have this really nice outfit for the summer that I'd like to buy because the weather's been getting pretty nice here in Reno. And when I get to the checkout, the cashier lets me know that if I open up an H&M credit card or H&M rewards card, something like that, I can save 20% off that specific purchase. So that sounds pretty good. We've all been in that position before, right? No matter what your favorite store is, almost every retailer has a rewards system or a card that they want you to buy. So you're there debating on whether you want to save that money up front or then maybe get involved in something that you haven't been able to research completely. But then there's someone behind you that has a lot of stuff and their kids are there and you don't want to take up too much time. So you have to make a quick decision. Well, you're not going to need to make a quick decision now because we'll give you all the information you need to have that ready for you at the time. So let's start off with how it works. So they're sold specifically for one retailer. So in the previous example for H&M, let's say, I wouldn't be able to use that H&M card at a place like Sam's Club. right? I can only use it at an H&M, whether in their network, that specific one that I'm at, or all over the nation. Secondly, and I'm sure we all know this by now, but they're typically introduced at the point of sales. But you could probably see a bunch of ads on the walls to sign up for the free rewards. And then one of the biggest selling points with these cards is that they're likely to get discounts on the purchases made with the card. So if you have a bunch of outfits, let's say, you go up, you get a discount on that. But in addition to that, you'll receive bonus points for purchases on further purchases. So it kind of stacks on top of each other. However, it's all going to one company. So you get those free points to buy free things at the store that you're already buying from, if that makes sense. So now that we thought about all the rewards and all the discounts, which are very nice, let's talk about the bigger picture, or maybe the more boring picture, the way you look at it. Regardless, it's really important. Let's talk about how these credit cards can impact your credit score. Great. So like any card, when you apply for an in-store credit card or a retail credit card, there's a hard inquiry on your account. And hard inquiry is made whenever you open a new account of borrowing any sort of money, and it temporarily decreases your credit score. It appears as a lower balance on your credit score and on your credit report. So opening the account also lowers the age of credit, which is one of the larger factors when making your credit score. This calculation is made by taking a combined age of your credit cards and dividing it by the number of cards you have already. So let's just think of an example. So if I made, or if I had my card for 5 years, my previous card for 5 years, then added my H&M card a year ago, my average credit would be 3 instead of 5. That's because I had 5 years on one and then 1 year on my H&M, so that equals 6. And then divide that by the 2 cards, that equals 3 years of history. So really quick math, you could do that with your own cards right now. It should be pretty easy. The ideal age is about 9 years, which will take a while. And the more you open up new cards, the more that's harder to achieve. Thirdly, an in-store credit card is likely to be subject to higher interest rates, which is not good, right? Interest rates are equivalent to the cost of borrowing. So you always want to pay low interest rate or none at all, right? Lastly, the security measures placed on in-store credit cards are not as stringent as those of an actual financial institution. They're not in the business of protecting financial institution or managing financial information. I mean, they're in the business of selling clothes, so it makes sense that maybe their security measures aren't as tight. So there are a handful of negative impacts that have to do with in-store credit cards. But let's summarize the core advantages in in-store credit cards before we move on. So if you're looking for a quick way of increasing your credit score, I know Dee mentioned that she was not eligible for it. On aggregate, though, they're usually easier to get approved for. Obviously, there's other cards that you can get, but it could serve as a decent option to get easily approved. Secondly, if you frequent at a certain store, perhaps getting an in-store credit card would work. So, for example, some people love going to Costco for their groceries, household needs, etc. If you're going to always go to a store often, it may be good to utilize those purchases by getting rewards and building your credit on top of that. So it could serve as a very good option. Lastly, in-store credit cards can potentially have a lower balance, making it easier to pay off. This kind of goes with the idea that since it's a specific store and you're only able to use that specific card on that store, that maybe you don't go there that often, so the balance is low and you're able to pay it off in full. This could work both ways though. There's something called credit utilization when it comes to credit cards. This is basically a percentage of your credit limit. Every card has a limit, and so if you spend $100 on a $1,000 limit, then you utilize 10% of your credit limit, which makes sense, right? So if you're a shopaholic, it's possible that you max out your credit limit, maxing out your credit utilization basically, and that would really devastate your card or devastate your credit score. It'd also make it harder to pay off your card in full, which would lead to paying higher interest, which we already mentioned was pretty bad, and that would lower your score as well. So some things to be cautious there, but there are some advantages to it, but it's all up to your idea of good.
All right. Thank you for that, Devin. Thank you for sharing all that helpful information about in-store credit cards and credit card debt. It's definitely important to know those things before saying yes. So with that being said, we're going to go into our second poll. So how many in-store credit cards do you have? Is it none? Do you have 1 to 2? Do you have like more than 2? What does that look for you? And it looks like we're waiting for one more person to vote. So I personally do not have an in-store credit card at all. Like I said, after that Office Max experience, I decided to hold off on that. And it looks like we have one person who does have an in-store credit card. We have 2 who have none. So if you have an in-store credit card, what store is it for, and why did you decide to go with that store? And you can unmute or type it in the chat. Okay, so Amy said Old Navy discounts. Yep. I honestly can't remember the last time I went to Old Navy, but I know like from their commercials, they always have really, really good deals. So yeah, that's a good one. Anyone else? That's probably it. So we're gonna go ahead and move on to point of sale loans. So you guys can hear all about those. They have great sales when you have a card with them. Ooh, I like the sound of that. So that kind of goes back to what Devin was saying. Sometimes it's worth it if you shop there often and you get a lot of rewards and whatnot. Okay. So we're going to go ahead and talk about point of sale loans because I'm sure you guys have probably heard about those. So I'm sure you guys have probably heard of point of sale loans before, even if you didn't quite know that that's what they were called. So point of sale loans or POS loans normally appear as an option when you're shopping or ordering items online during checkout. So you may have, put all your items in your cart, put in your address, your credit card information, all that good stuff. And then this pops up telling you to pay the minimal amount now and pay off your order in 4 payments. So some examples of this service are ones that I've mentioned before in the poll, Klarna and Afterpay. So these lenders normally perform a soft credit check on you, and you can find out immediately if you're approved for the loan. So when you think about in-store credit cards, you think about other kinds of loans, you normally have like a waiting period. Like you have to normally wait like 3 to 5 days or maybe even a week or more. But with these loans, you can, normally figure out whether or not you qualify right away. So it makes it a bit easier. So POS loans are typically paid back in installments of 4, and the interest is often lower than a credit card, or there's no interest at all. So before we, get too much into that, let's go ahead and take a look at what you should know before taking out a POS loan. So when you're considering a POS loan, it's important to read the terms of service because all of the providers have different plans. They have different terms. Now, I know normally when we use things, we just click that I agree box, but in cases like these, it's really, really important to go through the terms of service, look for specific things and read through to see exactly what you're getting yourself into. So in some cases, loans are 0% interest, while others can be up to 30% interest, depending on your credit score. So that's a big difference, 0 versus 30. So for instance, Afterpay has 0% interest on loans that are taken out with them. But Klarna, they have 0% interest on monthly loans, but if you're making like a bigger purchase that's going to take you longer than just like 1 or 2 months to pay off, you could be charged the annual percentage rate for Klarna, which is almost 20%. And when you're reading the terms of service, it's important to read what the penalties are for late and missed payments. So if you fall behind on paying back a POS loan, it can result in you not being able to take out another POS loan. I know that at times there are people who take out multiple POS loans. They take one out for Fashion Nova, they take another one out for Rue 21 or Forever 21. So it's important to know that if you're not really paying attention to those, terms, and you are missing payments or you're late on payments, then you may not be eligible to take out another POS loan for a while. And I see that we had some comments in the section. So Dahlia said, it's so crazy. I see Afterpay and Klarna everywhere, and I didn't know that they could impact my credit. Yes, that is the crazy part. A lot of times people like, this sounds great, but they're not really sure what they're getting themselves into. And then, so Amy says, can you let us know an example of when I would take out a PS loan for what kind of purchase? So yes, so as I was saying before, it's normally when you're like, it depends on the retailer. So I've seen a bunch of POS loans when I'm shopping for Rue 21 or Rainbows. I see Klarna pop up normally, and it gives me the option to pay off my order in installments. So let's just say I've spent like $100. Instead of paying that $100 right away, I can just pay $20 today, and then I don't have to worry about paying the other $20 off until the following week. So it splits up your payments so you don't have to pay everything at once. And that, oh, of course, no problem. And that kind of brings me to my next story. So I actually have a friend who spent a lot of money on her husband and his family. She was buying the expensive. She started her Christmas shopping in October, so she was ahead of the game, and she was buying air fryers, PS5 headphone sets, gaming chairs, skincare fridges, you name it, she probably bought it. So she decided to use Klarna to pay for these items because she didn't want all of this much money coming out of her like paychecks at one time. So she decided to use Klarna. But the catch is that she bought all these things from around October to December, and she's still paying these items off now. So it's important to understand how long you intend to, spend paying these things off, because it's one thing to be like, oh, okay, I'm going to pay this off in a month in 4 payments versus you end up having to pay off the items for 4 months. So I just wanted to share that story because I think that that's kind of an eye opener, and it shows us, to really be careful. So now we're going to move on to the pros and cons. So POS loans can be a great alternative to getting a credit card because the annual percentage rate is typically lower. But again, make sure you read those terms of service, because if it's 30% interest on the loan you're taking out, it's probably not worth it. It can also be beneficial when you're making a big purchase on something that you can't afford to pay for altogether at the current moment, but you're confident that you can keep up with weekly payments on it. So when I say this, what I mean is, let's say you want to buy some new clothes because, as Devin mentioned earlier, it's getting hot outside. Summer is upon us. It's spring, and maybe you're realizing your old summer clothes don't quite fit you anymore. You need a bit of a wardrobe change. So you want to buy some new clothes. Clothes are a necessity. And you decide that, the items that you bought are kind of expensive and you don't want to pay $80 right now for all of those items because you have other bills that are coming out of your paycheck this pay period. So you decide to, take the deal, take the POS loan with Klarna, and then come back and pay it off the loan your next pay period. This is you knowing that you can pay this loan off directly right when you get, your next paycheck or something. It's not you taking out a loan that you can't really afford. You are confident that you can pay it back on time, and that is why you're taking this loan out. So taking out POS loans can be a bad idea if it's an alternative because your credit cards have been maxed out and you want to make a really big purchase. So this might worsen your financial situation if you have an extra loan you have to pay off, and you now have multiple loans in your credit card debt at the same time. So from what I noticed with my friends who use things like Klarna and Afterpay, they'll normally take out multiple at a time. So they'll take out a Klarna loan on Route 21, they'll take out a Klarna loan on Forever 21. They'll take out Klarna loans at different retailers. So that's multiple that they have to pay back at one time. So if your credit cards are maxed out, then not only are you having to pay on 2 to 3 credit cards monthly, but you're also having to pay on these 2 POS loans or however many you take out. So that leaves you with more of a likelihood of, having later missed payments, and that can affect your credit. So overall, it's important to evaluate your options before you take out a POS loan, especially if you don't need the item right away. If you don't need it, then it's best to just wait until you can afford it and save up for the item. So now we're going to move on to our third poll. Thank you, Amy. So here we go. It's, have you ever heard of a payday lender or know what they are? I personally have heard of payday lenders and I know what they do now, but I know when I'd first heard of payday lenders, I didn't really know how it worked, but I'd heard of them and I knew it was bad. That's all I knew. Okay, it looks like everyone has voted. So we have 2 out of 3 that says, I've heard of payday lenders, but I'm not sure what they are. And then we have 1 person who says, I've heard of payday lenders and know what they do. So that's great that that person knows that they've heard of payday lenders and they know what they do. I was previously in the first group, heard of payday lenders, but you're not sure what they do. So with that being said, we're going to go ahead and talk about payday lenders so you will know what they do. So payday loans are short-term, high-interest loans that are available to consumers. So these loans are normally based on how much you earn, and the amount borrowed on the loan is how much you earn from your next paycheck. So an average payday loan has an interest of about 400%, which is extremely high when you compare that to other loans such as student loans. It's a big difference. So, for example, when it comes to student loans, in the last 10 years, the interest rate has ranged from about 2.5%, which is this year, it being the lowest, to about 5%. So when you compare 2.5% and 5% to 400%, that's a huge increase. So it's good to kind of be aware of those things. And the reason why people often recommend against payday loans is because taking out a payday loan often creates a debt treadmill, because the majority of your paycheck goes back to paying off that loan, and it makes it extremely hard to pay off. If you're constantly having to use half your paycheck, 3/4 of your paycheck to pay this loan off, you can never afford to pay extra to go ahead and pay the loan off. And meanwhile, the interest on the loan is still accruing. So it's always very important to consider other options and alternatives to avoid taking out these loans, because it can take a really long time to pay off. And it's, in the long run, it may not really be worth it. Yeah. Amy said, 400%. Yes. So I'm going to go ahead and, Michelle, it's crazy. Yeah, definitely stay away from those. So I actually wanted to share a story. So an example of a true story that actually a friend told me once. So meet someone, we're just going to call this person John. He needs money. It's about $300 to be exact. He's in a bind and he needs the money now. Like, he needs it right now. So he visits a payday lender and he writes the check for $360 so he can borrow his $300 and he'll pay a fee to the lender that's about $60. So the payday lender will hold John's check for about 2 weeks and cash it at that time unless he returns and needs to roll over the loan. So he can't pay the loan back in 2 weeks, and a cycle of borrowing continues. This is the beginning of the debt treadmill that I was talking about earlier. So before John turns to his bankers for help, he's paid over $1,100 on a $300 loan, and he still owes the original $300. So when he ultimately comes clean, he discloses that he owes money to 6 different payday lenders. That's crazy, 6 different payday lenders. And it's a true story. It's not at all common. Another statistic is 40% of Americans aged 18 to 34 years old, so we're in that age range, use non-bank borrowing methods like pawn shops and payday loans. So 28% of the same population have overdrawn their checking in the past year. So when you think about payday loans, it's very, very important to consider those things because you can easily, you may think, oh, it's a small amount, I can pay this back. And then, you kind of end up in a similar situation such as John. You've already paid almost triple what you originally borrowed, and you still owe the original amount. So important to consider. But thank you guys for listening about payday loans. Hopefully now you have a better idea of them, and I'm going to go ahead and pass it over to Devin.
Thank you very much, Dee. So yeah, we talked about payday lenders, POS loans, in-store credit cards. If you've been to any of our other presentations, we've talked about student loans and credit cards quite a bit. So now we're going to talk about some of the best practices that you could utilize for basically any debt or any borrowing that you have, to make sure that you're paying the least amount possible, or at least you know what you're doing or what you're getting into. And right off the bat, I could just say payday lenders are not the best place to go, from previous experience, just from coaching. However, I haven't taken out any loans from payday lenders, but seeing coaching people who have taken out money there, it could be really hard on a lot of people, and it's something that you don't want to be involved in, really. So back to best practices. So debt financing of any kind can be seen as unadvisable for non-essential items. So things like a housing, you take out a mortgage, that is debt financing. Debt financing is anything that where you borrow money to pay for something. So things like a mortgage, paying for groceries, those are things that you need to live. If it's absolutely necessary, it is a good idea to go into debt for those certain things because you need them to survive. However, non-essential items like an excess amount of clothes or paying delivery for ordering in, getting into like credit card debt or in-store credit debt, or even POS loans at some retailers, it can be seen as very unadvisable just because you're paying more than necessary for that specific item if you're paying any interest on that. And you don't want to get involved with that, really. Next is make sure to understand all information when borrowing money. This is something that payday lenders kind of thrive in, is they count on you as the consumer to not know exactly what they're getting into. And then it costs people a lot of money. So make sure you know everything about everything. Read the terms and conditions like Dahlia was mentioning. Understand your credit card limits, understand your interest rates. Those are big factors into how much money you're going to potentially save or lose, depending on how you use that sort of borrowing. Next is avoid paying any interest when borrowing, or avoid paying as much interest as possible. Like we mentioned, interest is bad if you're not the one making it. High interest, you don't want to be subject to, like the payday lenders of 400%. So if you can, pay things in full, like with a credit card. That could be in-store credit cards. They could be the Klarna POS loans. If you pay in full, you're going to avoid any fees and you're going to avoid any interest, which is good. You're just going to be paying what you intended to pay for that item. Next, small purchases are less likely to require financing. And this just makes sense. Not everything can be paid for in cash. So things like a mortgage, things like getting a car loan, paying for your education, it's reasonable to take out any borrowing for those items. But small things, like I mentioned, clothes, you don't want to be in debt for like a television, because a television doesn't provide as much value as, let's say, a roof over your head. So you want to save your money for those things, not lose them on small things. Lastly, have a plan. Don't buy it unless you know how you will pay for it. This is a good way of thinking about things, no matter if you're borrowing or not. You got to know how you're going to pay for things. You got to know if you want to pay in cash. Sometimes it might be better to take a payment out on something if you feel like you will be less likely to make an important payment like your rent or your electricity next month if you pay for it in full. But if you are going to finance it, make sure you know exactly how long that's going to be, know if you could pay for it in full or not. So those are some good practices to take away from this presentation, and I hope it helps you in the future when taking out any sort of borrowing. And now let's talk about Equity. So Equity partnered with the University of Nevada, Reno. It's a very interesting app. It's great and it has good use for college students. So it can help you discover on and off campus resources, learn about events with free food near you. Everyone loves free food, especially this next semester or the summertime when campus starts opening up. Will love to have free food and get to see each other in person for the first time in a long time. It also can help you easily manage your personal finances. That's something that us at Nevada Money Mentors are very passionate about, as well as it helps things like finding resources for food insecurity or housing insecurity. So a lot of great stuff you could find in Equity, and not to mention it's just a very clean app and easy to use. You could find that on the Google Play Store or the Apple App Store, and you could use that QR code right there if you want to sign up quickly. And now let's talk about our social media. So try to stay connected with us. You can find us on Twitter, Facebook, YouTube, or Instagram at NV Money Mentors. We have many of our past presentations up on our YouTube channel, as well as this one will most likely be updated onto the account in the next couple of days. So feel free to look at those. Then Instagram, we have a bunch of fun events, whether it's sweepstakes, announcements of new presentations, or letting you know where to be when we have a presentation. And then I believe Dahlia is going to take it away and talk about who we are and what we do.
Alrighty, thank you for that, Devin. So yes, we want to share a bit with you guys about our program, Nevada Money Mentors, in case you haven't heard about us or you've heard of us but you don't know what we do. So Nevada Money Mentors is a free resource on campus for students, and our office is actually located on the third floor of the Fitzgerald Student Services building. So it's this big building. It's right by this big field in front of the KC, and we're on the third floor in the back of financial aid. So if you've had to visit the financial aid office, then we're there. Our most popular services are one-on-one financial coaching, workshops, fun events, and in-class presentations. So pre-COVID, you may have seen us on campus doing tabling events, whether it was Name Our Pig, because that's the Nevada Money Mentors mascot, or rolling in the dough or saving a latte. We were giving out donuts and free coffee. So you've probably seen us on campus doing those sorts of things. So if you want to learn more about what we do, you can go ahead and visit our website at unr.edu/Nevada Money Mentors and go to our About page. So financial coaching. Maybe you don't know what financial coaching is. Maybe you want to hear a little bit more about it. So financial coaching is when a student works one-on-one with a peer mentor in a free, confidential, and non-judgmental environment. So our peer mentors are students. They're students just like you. They're in similar situations as you, so they can relate to you on a more personal level. And the service is free. You don't have to pay for it. It's confidential. After coaching sessions, no one's going to go around the office blabbing your personal info. It's personal, and that's the way it stays. And non-judgmental. If you spend $400 a month on Starbucks, no one's going to judge you. We're just going to see how we can reallocate that if that's something that you want to do to save money, but we're not going to judge you for your expenses and your spending. We're not going to do that. So by working with the peer mentor, the student is able to set goals and to create action plans while also being held accountable. So making you more likely to achieve your goals, because you not only do you have an accountability partner, but you also have someone who can give you helpful information on how to do certain things. So that's what makes coaching participants so successful. They have someone to help them along their financial literacy journey. So if you're interested in becoming a coaching participant or wanting to try it out to see if it's for you, then you can just visit our website, unr.edu/Nevada Money Mentors, to schedule an appointment with a money mentor. And we are doing virtual appointments at this time, but we look forward to possibly starting in-person appointments once the fall semester begins.
Thank you for letting them know that, Dee. Now let's talk about the upcoming events that we're having for Financial Literacy Month. So exciting. Thank you guys for showing up to our first presentation, The Real Cost of Shopping. We hope you enjoyed it. Next up, April 15th, we have student loan repayment. That's very important for those who are graduating soon. April 22nd, traveling on a budget. That's going to be a collaboration with the University of Northern Texas, UNT. So that'll be fun. You get to see kind of a different perspective all the way down this other side of the country. April 22nd, we have Winning at the Game of Life, which is a reoccurring event for us, and a lot of students love it. You get to experience what life might be like in the future, depending on what your career is, how much money you make, to see if you're going to be able to live the lifestyle you want. Lastly, we have how to avoid schemes and scams. That'll be very exciting. We'll go over specific scams, how to catch them, how to avoid them, because I'm sure we've all seen them. So thank you again, and we hope to see you guys at one of these presentations.